In essentially, a hedge fund manager named Kyle Bass flew to Tokyo, held a press conference, and announced he was making one of the biggest bets of his career. Japan's government, he said, was carrying debt so massive it would trigger a bond market collapse within 18 months. He called the trade a generational opportunity.
14 years later, Japan's bonds have still not collapsed. Bass is not a fool. He correctly predicted the US subprime crisis years before it happened. But Japan's debt is by now the most famous trade that has never worked. Market veterans call shorting Japanese government bonds the widowmaker, not because the market is safe, but because so many smart people have lost money betting against it and been wrong.
In January, Nichen Isa's Japan's 40-year government bond yield hit 2.2%, the first time that maturity had ever crossed that threshold since it was introduced in Nichen Nanatain. The 10-year yield touched Nitengo.
Maybe. Or maybe the same structural forces that made Bass wrong in Ruckensra are still doing their work. Japan's gross government debt stands at roughly 40% of GDP, the highest ratio among developed economies, and it's not close. The United States, often cited as fiscally reckless, sits around 4%. Greece, when it blew up in Ruckensra, was at 4%. Japan is at Ruckensrofnis% and rising. In absolute terms, outstanding government bonds reached 10.6% trillion yen, or about 110 billion, approximately the size of Germany's entire economy.
If you look at that number and your instinct is to panic, that instinct is understandable. It is also, based on century years of evidence, probably wrong. Not because the debt doesn't matter, but because debt is never just a number, it's a relationship. And Japan's relationship with its debt is unlike almost anything else in the developed world.
Start with who owns it. When Greece's bond market collapsed in Nitieri, the critical factor was not the size of the debt, it was who held it. 8 out of 10 euros of Greek sovereign debt were held by foreign creditors, German banks, French pension funds, international bond funds, who had no particular loyalty to the Greek economy and every incentive to sell when yields started rising. Once panic started, foreign holders fled, yields spiked further, and the spiral became self-fulfilling.
Japan's debt is structured almost exactly the opposite. As of late Nisen Yurasing, Hashi Beiten 1% of all Japanese government bonds were held domestically. The largest single holder is the Bank of Japan itself, which owns approximately 66% of all outstanding JGBs. Domestic insurance companies hold another 10%. Domestic and banks hold a 10%. Foreign holders account for less than 10% of the market.
This changes the dynamics entirely. When the Bank of Japan holds nearly half your debt, the standard debt crisis mechanism, foreign creditors panic and sell, simply cannot operate at full force. The BOJ is not going to trigger a run on Japanese bonds by panic selling. It is the Japanese government's central bank. The relationship is more like a company that owes money to its own pension fund than like a country that owes money to hostile foreign creditors.
The second structural shield is currency. Japan's entire debt is denominated in yen, every single bond. There is no dollar clause, no euro clause, no mechanism by which Japan can suddenly find itself unable to pay because its currency fell. As economist Paul Krugman and others have noted, there is no historical precedent for a sovereign debt crisis in a country that borrows exclusively in its own currency and controls its own central bank. Greece couldn't print euros. Argentina had dollar-pegged debt it couldn't service when the peg broke.
Japan has neither problem. This doesn't make debt infinite or consequence-free. It simply eliminates the specific mechanism that has triggered every major sovereign debt crisis in the last 50 years.
The third shield is Japan's external position. Despite losing its title as the world's #1 creditor nation to Germany in May, primarily due to currency movements rather than any deterioration in fundamentals, Japan still holds 13.7 trillion in net foreign assets. That is the second largest pile of overseas wealth held by any nation on earth. Japan is simultaneously the world's most indebted developed economy by one measure and one of the world's wealthiest nations by another.
The current account surplus, the ongoing flow of returns from those overseas investments, is projected at 6% of GDP in Nisen Nijreluk according to IMF estimates. Japan continues to earn more from the rest of the world than it pays out.
This is the closed loop that Base and others have consistently underestimated. Japan's government borrows from Japanese savers and institutions. Those institutions earn returns on overseas investments. The current account surplus recycles wealth back into the domestic economy. The domestic savings pool funds the next round of government bonds. The loop stays closed.
Now, Warseung-Yu's genuinely more complicated than Norseung-Yu-den. The event that spooked bond markets in January wasn't just abstract fiscal concern. Prime Minister PM Takaichi, after winning a snap election on February unveiled what she called a Norseung-Yu trillion stimulus package. In English, the media was calling it Sine economics. The package included explicit plans to abandon years of fiscal austerity, consumption tax cuts, massive infrastructure spending, and a deliberate rejection of the primary balance targets Japan had been nominally committed to for a decade.
Investors already watching the Bank of Japan reduce its monthly bond purchases from 4,000 trillion in August, to roughly 10 trillion by early Nijreluk realized immediately what this meant. The BOJ is buying less, the government is borrowing more. Someone has to absorb the difference. And unlike in the era of quantitative easing, when the BOJ would vacuum up whatever was issued, the private sector now has to set a price.
That price, evidently, is higher yields. Japan's fiscal Nisen Nijreluk budget assumes a 3% interest rate for bond calculations, the highest such assumption in nearly 3 decades. Total debt servicing costs in that budget reached 3.10 trillion, roughly 1/4 of the entire FAC Nijreluk B10 trillion government spending plan. According to Bloomberg reporting from late Nisen Nijreluk, those interest costs are projected to double by Nisen Sanyu if rates continue rising.
So what's the verdict? The debt will not cause a sudden crash of the kind that happened in Argentina in May or Greece in May. The structural shields, domestic ownership, yen denomination, net creditor position, are real and they work. The widowmaker trade remains a widowmaker for the same reasons it always has been.
But the mythbuster here cuts both ways. The people who screamed crisis in Nijreluk were wrong, but the people who said Japan's debt is no problem at all are also increasingly wrong. The real story is slower and less dramatic than either camp wants.
As we explored when covering the BOJ's rate normalization in episode Sansi, the carry trade unwind has already begun redistributing trillions of dollars in global capital. That process is not complete. As the BOJ shrinks its balance sheet, it has cut roughly $1 billion since beginning quantitative tightening. Private investors must absorb bonds that the central bank previously held. Japan's domestic savings pool, once seemingly bottomless, is shrinking as the population ages. Younger generations save less than the post-war cohort that built Japan's original surplus.
The real risk is not explosion. It is slow compression. A Japan in which rising debt servicing costs gradually crowd out spending on defense buildup, childcare subsidies, infrastructure, and the innovation investments needed to stay competitive in the AI era. Not a crisis, but a steady narrowing of fiscal options over the next decade.
Japan's debt is not a bomb with a fuse. It's more like a slow leak in a very large, very carefully engineered boat. The engineers are competent, the leak is real. The question is whether they can patch it before it matters, and whether Sano economics has just made the leak somewhat larger.
For now, the widowmaker trade remains a widowmaker, but the structural story of why Japan's debt is different is being tested in Nisen Nisluk in ways it hasn't been since the 1990s. The closed loop is not broken. It is, however, being stress tested.
That is the Japan factor, a country that has built an economic structure so self-contained, so domestically reinforcing, that the conventional rules of sovereign finance genuinely don't apply. The debt ceiling debates that periodically paralyze Washington have no Japanese equivalent because Japan's government is in the most important ways borrowing from itself. The risk is not that foreign creditors walk away. The risk is that the internal circulation slows, that the aging population draws down its savings, that domestic institutions lose their appetite for long-dated bonds, that the closed loop gradually opens.
30 years ago, the smart money said Japan was 6 months from crisis. Today, the 40-year bond yield is at an all-time high, and the same prediction is being made again. History suggests skepticism, but skepticism is not complacency.